Hey guys, what's going on? Just thought I'd do a quick little video talking about how I invest in the stock market. Not just the stock market, actually, it's kind of like investing in general. So, about 4 years ago, I started reading Tony Robbins' Money Master the Game. It really got me inspired to try and find a way to maximize my money, not waste as much, and also invest for the future so that I can live off that income. At the end of the day, that's why anybody invests. People may buy stocks that don't pay dividends and sell them later on, but that's more of a speculation than investing. You know, if you're investing, you're doing it for money. You're doing it for income later on down the line. So after reading Money Master the Game and a few other books by like Jack Bogle, Robert Kiyosaki, and other people, I decided to take advantage of my basically UK version of a 401k. This basically is a pension that I can invest a certain percentage of my income, and my employer gives me a certain percent on top. Currently, I'm putting in 5%, and my employer gives me 6. It should give me just 5, but because I've been there quite a long time, they give me an extra percent. So straight out the bat, I've got 11% of my salary before tax going into a pension. It's tax-free whilst the money goes in, tax-free whilst it grows, but I will pay tax when I take the money out. So I don't have that managed by professionals. I do it myself. After reading Tony Robbins' Money Master the Game, I realised that 96% of professionals can't beat the market. So with my pension, what I do is I invest that 11% just into a broad market index. I think it's like 70% US, 30% UK. And that just trickles along every month. Dollar cost averages in. I'll do a video explaining lump sum versus dollar cost averaging. And it just goes automatically out of my paycheck. After that, so in terms of real estate, currently bought one property that we're living in, we've renovated, really happy with, and made probably around 20% on the value on top of what we've paid for it in such a short space of time. But the idea with that is we stay in it for another 5-10 years, rent it out when we move to a next property, and then do a similar thing. We're either going to buy another house that needs new kitchen, bathroom, etc., and then renovate it and then live in that one for a while until it's cash flowing positive, and then move to the next. I do own a little bit of REITs. So REITs are real estate investment trusts. I do like these because unlike buying physical property, you get to own lots of different properties with a tiny lump sum. The fees are next to nothing, and you don't need to be worried, have I picked the right property? Instead of putting all your money into one property, you can own like 1,000 shops, and then instead of worrying, is my one house or shop occupied, you know that you've got 1,000, so as long as 99 are covering it, it's all right. And they produce a reasonable yield. The downside to the REITs as opposed to the buying the physical ones is you can't leverage them, or shouldn't leverage them. So I do put a little bit of money into a global REIT that's provided by HSBC. Outside of real estate, predominant focus is stocks and shares. So I do have a ISA, which is like a Roth IRA, and a new lifetime ISA. They're both similar to like the Roth IRA. You're putting money in, you've already paid the tax, but it will grow tax-free, and then you'll be able to take the money out cash-free. My aim with that is to put in a reasonable amount a month. Some months it might be 5% of my income, sometimes it can be up to 20% of my income, but that really does fluctuate depending on basically money coming in. How that money is spread out, predominantly US market, a little bit UK market. I do have some money in corporate bonds, so I try and go for around 5% in corporate bonds. Now, the reason why I do this is kind of my emergency fund. So where a lot of people like Dave Ramsey say save up £1,000 and then build up to 6 months, I like to do that in corporate bonds because it's getting me a better percent. It's keeping up with inflation. So currently, like I use a Fidelity corporate bond fund, and after fees, that's making me around 3% a year, which is higher than the UK inflation, and it's very liquid. So if I do need to take money out, I can. And because it's bonds, when we've had the recent crash thanks to COVID-19, that account was actually up. I feel like a lot of people were dumping money into bonds to try and save some of their cash, and that actually bumped up my fund. So that fund has not been affected by the crash in any negative way. I am working, and that means I don't have to touch my emergency fund right now. So currently I'm still just plowing money into that. Yes, my S&P 500 and my US and my UK stocks, they've took a big hit, but I'm buying in every month, and that will average out the price. I'm seeing this as an opportunity to buy very good stocks at a better price than what it was a couple of months ago. The only other fund that I hold in my ISAs is the Global Property REIT that I explained earlier. Now, I do have another account, and this is purely a fun account, and this is with a company called Freetrade. So Freetrade is a UK app that basically lets you buy and sell individual stocks for free. Now, it's not exactly free. You still have to pay stamp duty. There is an ISA available, but it's £3 a month. So if you've got a small account value, it's hard to actually justify that £3 a month. So I just have the standard account. I pay taxes on it, but in the UK currently that account is not past the thresholds or the allowances to actually start paying tax. So currently it's not, but I only use 5% of my total net worth in my Freetrade account. Now the reason why I use the 5% is so that if I lose all of it, well, I've still got 95. And I saw this a long time ago from, I think it was Warren Buffett, that was like, never have more than 5% in a specific investment. And it just seems reasonable. If worst case you've got 20 investments, 5% in each, even if one does tank, you have got the others, so it should negate some of that risk. Obviously the risk doesn't change, you still could lose all that money, but yeah, that's just my play thing. So what I do with that is predominantly every Monday, or quite recently it's been every day. So I wake up, stock market opens at 8 o'clock, I watch for the first 15-20 minutes, see what's rising, read news articles on like Seeking Alpha and that kind of stuff. When stuff starts to rise, I buy in, sell it a couple of percent later. Now, that account, it is small, it's 5% of my net worth, and within that I've got 20 or 30 holdings. The highest I've had is like up to 50 holdings, so even the individual trades aren't a lot. And that was a decision that I made thanks to Sasha Ednikov. You should check him out on YouTube. He's a fantastic trader and does really good analysis at breaking things down as to how you should invest. And he really persuaded me to go down the route of lots of small trades, being positive every day or every 3 days, that kind of stuff, and slowly, gradually making up that account. So yeah, that is just a short video of how I invest. If you guys have got any questions, drop them down in the comment section. Please like, subscribe, and I'll see you in a couple of days. Thank you.